Hello and welcome. I am giving everybody a chance to join in before I get started. Just a couple housekeeping items. This is a webinar format, so unfortunately, I cannot see all of your amazing faces while I'm speaking. There also is the option where you can use the Q&A as well as the chat. Both are open, so I will ask some questions as we go along. You guys can just throw your answers in there as we're talking. Um, and if you have anything that you need while I'm talking, obviously you can throw it in one of those two as well. The Q&A specifically, if you have a specific question about something that I'm talking about, I'll make sure that I run back through that at the very end so that I can capture that. And then obviously the chat, you can answer questions that I ask throughout in that. But you are here today because we are talking building a capital ready business. This is brought to you by Accelerate Columbus and the Accelerate Columbus program. So if you guys have been involved in that before, if you haven't, you have the opportunity to sign up if you are a City of Columbus-based business. If you are not a City of Columbus-based business joining us today, unfortunately, you cannot be part of this program. However, you can obviously take part in this particular workshop. So I'm going to go ahead and get started. I have quite a bit of material that I'm going to cover. This is only an hour long, so I'm going to move pretty quick. My name is Christy Dudgeon. I am the president of SBC Bookkeeping and Consulting. We are working through the Accelerate Columbus program in order to bring accounting, QuickBooks training, that type of financial advisory work through the program. It's a great program if you've not been able to be a part of it. We also provide bookkeeping and consulting throughout Columbus as well as Ohio and on a national scale as well. And this is our team in addition to me. You guys, anybody working in the program or working with us might have the opportunity, right, to encounter any one of these people that are in this picture. So, what are we covering today? What financial records actually matter to us? What do we need from a building a capital ready business? Why lenders and advisors are actually reviewing them, not just reviewing them, but what they are looking for as well when they're reviewing them. What our reports are actually telling us or what we would need to know, right, from those reports and what to organize next in our business. So, how would you describe your business financial records today? And this is one of those answers you guys can drop in the chat, either A, B, C, or D. So, everything is current and it's organized. It's mostly organized, but there's a few gaps. C, you're behind and need to catch up. Or D, you're not sure what you should be keeping, right? And so any of your businesses could be anywhere in here. And as I mentioned, feel free to find the chat if you're not sure where those buttons are. They should be on the toolbar across the bottom of the screen. And you can just click on chat. You can also click on that Q&A in order to drop any of those questions that you have. So Mike has answered. It's mostly organized, but there's a few gaps. So that's a pretty common response that we hear, as well as C or D, right? Very few of us are actually going to say, I've got everything current and organized. So what does capital ready actually mean? Capital ready means that your financial information for your business is organized. So you could find it if somebody were to ask for it. If I was asked to ask you right now, you say, I've got it. I'm going to hand it over. It's accurate. This is the other part. My records reflect what actually happened. And when I speak to accurate, what I mean is your tax returns match whatever your financial management system is. So if you're using QuickBooks, if you're using a spreadsheet, if you're using something like that to develop your reports, they're going to match each other then. And it's current. So if I were to ask for it today, you could say confidently through last month, right? So typically when we're managing our financial information, from an accuracy standpoint and an up-to-date standpoint, we talk in the prior month because it sometimes takes time to get those bank statements. They're not necessarily going to be there on the first day of the month. So we work in kind of a overlap there. So if you were to say, yes, everything is complete through the end of July, right? And it's accurate, it's been reconciled. And we'll talk about what some of those terms are that I'm saying. And it's understandable. And so this is the next piece. So in order for us to know if it's truly accurate, if it's truly current, we also have to understand what those numbers are and what they're telling us. So you're able then to know what they are and what they're telling you. You're able to speak to them. You're able to defend them, is another word that I use a lot, which means I have categorized something here because that's what that truly is, right? And so that's defending what the number is. And there's a number of people that you might have to defend that to. It might be your accountant, it might be your tax accountant, it might be a lender, right? Or someone who is potentially going to give you a grant so that you could explain it. It does not mean that financing is guaranteed, right? So we can have the best looking financials, everything accurate, organized, up to date, and there's still no guarantee at the end of the day that we're going to actually receive financing. But why strong financial records matter, why we need to have them organized, not only if we're seeking capital or we're trying to grow a capital ready type business, but it from a business owner standpoint, we need to have this information in order for us to truly understand business performance. Especially when we're starting out in business, we often don't understand these reports. We don't have the system in place to manage it or to even create the reports, and we're just using our bank account. We know that money's coming in and money's going out, but we really don't have visibility to what our business is doing, right? What difference it's making when we change things in our business. We're not sure if our pricing is accurate, and we're not really making decisions based on data. We make a lot of decisions based on intuition. There's always that gut feeling when we're a business owner is if this feels like the right thing, right? And so having this strong financial records or this strong financial foundation matters because we can make those decisions then not only just based on our intuition, but also based on this data that we're able to see. We can plan for growth. So maybe we want to hire someone. Maybe we want to buy a piece of equipment or a property, or we do want to have a loan because we want to add a product to our business, and that's really going to change the way things look. So having this financial records that are accurate matters from that standpoint because we could see really what was happening within our business. Definitely from a preparing for financial conversations. Many businesses that we ultimately end up working with through a program like Accelerate Columbus, or if you go to ECDI or the SBDC or the Women's Business Center or any of those entities out there that are helping small businesses prepare for this, is that sometimes the very first time someone has looked at your financial records is actually someone who was potentially a capital lender or someone of that nature. And that's definitely not the first person that you want to have look at them. So in order to have those reviewed by someone, right, as one of these programs is a great benefit to a small business owner so that you can know that everything is organized the way it's supposed to be, that you have that information in there that's accurate, and then being able to have that confidence to have conversations to what you're actually seeing. And then also communicating with tax. So we have to have all this information organized in the correct spot so that we are paying our taxes accurately. Definitely from a bookkeeping standpoint, right? Bookkeeping is the helping organize that information, and then other financial professionals that you may be encountering throughout your business. Um, That's funny. I just got a text message from someone that says they can't get in, so I'm not really sure. So what is a capital ready framework then? So ready framework means being organized, so I can find that information, right? It's accurate. My records reflect what actually happened. I understand it. I know what my numbers are telling me, and then I'm prepared. I can provide that information with needed. So these four elements working together will make your business more financially strong, professionally ready, and most importantly, opportunity ready. And when I say something like opportunity, it's not just the opportunity for capital, right? It's the opportunity to make that decision to grow, to make that decision whether I'm going to spend more on advertising to increase my revenue, if I'm going to take on an equipment expense that potentially is going to create more jobs, right? And those types of things. So opportunity ready is definitely a full scale of things. But in order to get to the point where we've got these financial systems in place, we're able to know if they're accurate, we're able to confidently speak to all of them. We have to start with a foundation. And the foundation of building these is the single most important part, right? If we build the foundation well, we can stack on top of that, and the system is built. So reliable reports start with all of these reliable records. So the foundation includes, first and foremost, a business bank account. So if we've got a business that's set up, right? So in order for us to get that business bank account, we have to be a legal business. So sole proprietor partnership, LLC, S Corp, C Corp, whatever one of those entities may be, and an EIN number. That's typically what banks are going to ask for. Other banks may ask for your articles of organization, and kind of your management structure, how that's broken down. So there's certain different documents that most banks can ask, but usually first and foremost, they're going to want to know, are you registered with the Secretary of State and do you have an EIN number? And that's how you end up getting that business bank account. There's a couple reasons for that, right? We want to make sure that we are keeping our business expenses as well as income separate from personal. We'll talk about that here in a little bit. That's a big thing with being capital ready, is making sure we've got those separate, as well as you've got everything that's happening with your business in one place or multiple places, depending on how many bank accounts you have. And then some kind of bookkeeping system. And this is really it sounds simple enough to say bookkeeping system, but there's a lot that goes into having an accurate and correct bookkeeping system from a foundation standpoint. And if you guys have heard any of our conversations before or worked with any of us, definitely from a QuickBooks training standpoint, first and foremost, you want to have a chart of accounts that's simple. And it's not even a QuickBooks thing. A chart of accounts is a universal term across all different types of bookkeeping systems. So, as I mentioned before, it could be a piece of paper, it could be a spreadsheet, it could be something like QuickBooks or Wave or Zero or one of those other softwares that you could potentially use, or you're outsourcing it, right, to a bookkeeper that is an outsourced bookkeeper or a CPA even. Depending on the size of your company. So having a bookkeeping system that's not only just a foundational piece, but making sure that information is accurate. So an example of this, I just got off of a meeting with a business owner in South Carolina. And so, very simple business structure. She's a consulting firm. So, she doesn't have a lot of transactions from an expense standpoint, right? So, consulting firms are generally very easy to set up from a bookkeeping standpoint. However, because they have reimbursable travel expenses and things like this, they've gotten some really bad advice from that foundational standpoint. And QuickBooks likes to set up a chart of accounts that usually is 7 times larger than the one you actually need. So there's a lot of work that you're going to end up doing to clean up the chart of accounts in order to scale it down to the size of business that you really want. And there's an entire class on all of this outside of it, so I'm not really going to go into it that much. But if you guys want to watch any of our other workshops that we've done on this subject, you can go to SBC First on YouTube and see that. This class as well will be in that same spot. Once we get done here today, it's being recorded. So I'll send everybody the link, but also you're free to watch anything on there that you want to watch, particularly about QuickBooks or setting up your financials correctly. Mike has a question. Does Square count as a bookkeeping device? Now, in itself, it's a component of bookkeeping because it's tracking your income, right? So anytime anybody's buying something, where Square falls short, it's not actually bookkeeping because it doesn't do the whole full circle of bookkeeping. So it doesn't do the expenses, it doesn't do your assets, your liabilities, liabilities, and your extra, your equity, those other pieces and parts of it. So typically Square as a POS system or any other POS system out there is going to connect into and be a piece of that bookkeeping system though. Keeping your receipts, any kind of documentation as well, regular account reconciliation. So, account reconciliation needs to occur every single month. This is the process of where you are matching up all of the values that have occurred throughout a month in your bookkeeping system to ensure that they are accurate against a statement. So, every month we get a checking account statement, right? We're going to go through either that spreadsheet that we've got or QuickBooks or something like that. It's called a reconciliation process. You might have also heard it's called a month-end close process. Reconciliation is part of that. So you would run through all of that. And then having that clear separation of business and personal activity, as I mentioned before. So this is a trap that a lot of startups end up falling in because we spend so much of our personal money. Either we're bootstrapping or we're borrowing it from someone else or whatever it may be, right? And so we are really funding everything that's happening in our business from the very beginning. And then we just kind of continue with that. The other thing that happens is maybe we don't have our business set up right with the Secretary of State yet, so we don't have that separate business bank account, and we're using a personal account. Definitely my best advice here is wherever you fall in this, get it separate as fast as possible. You do not want to mix those two. It's called commingling. And I go very deep into this into some of our other workshops. And so you want to make sure that you are freeing your personal world from your business world as quick as possible. And that means have separate accounts, right? And so you are still probably funding a lot of it. These are end up being called owner's investments is the term on the QuickBooks side. But there is a way to properly account for that in your books to ensure that the actual movement of the money or the movement of the paper, right? This is a cover your tail kind of thing. To ensure that you're using what's called equity in your bookkeeping system in order to properly account for those investments. And so, same thing with transfers out of the business into your personal account. If you paid your car payment or you paid your credit card or whatever that may be, you don't want to call that exactly what you did on the personal side, right? You're going to call that an owner's draw and it's moves through. So, this is where I'm speaking from the making sure that things are accurate standpoint, right? And so if you're not sure how this movement is or what these things look like, right, that's certainly ask for help to ensure that that's properly set up and you understand how to make that movement correctly. So, financial records, every business should then maintain. So, common records that you need to keep you organized is always going to be your bank and credit card statements. So, we get these all the time, right? And as I mentioned before, we are matching up the values of all of those statements into whatever record keeping system we have from a bookkeeping standpoint. Also, sales records and invoices. Now, most of these are actually going to be accounted for in some kind of software if we have. This is where software becomes nice, right? So we don't have to keep necessarily paper copies. Most of these softwares will actually let us upload a copy of these items into it. There's also apps within a lot of these softwares that we could take pictures of things like receipts and sales records. The invoices themselves, if we're utilizing the system to create those invoices, then they're already going to be in there. So this is not something extra that we're going to be keeping. If you're using an outside invoicing system, then you're going to want to make sure that you've got those entries backed up into the system. As far as what Mike was mentioning with Square, Square is keeping track of every single one of those transactions that's happening in Square. So basically, every time somebody's swiping their credit card, right, Square is keeping track of that. However, if you're utilizing a software system, you're gonna those entries need to talk to each other. And so, a big inaccuracy that I see a lot actually happens to be with POS users. So if it's Square or it's Clover or one of those, and then they're also using something like QuickBooks, you do have to make sure that your entries every single month as part of this month-end close process, that the report that you have from Square accurately is reflected in QuickBooks. And what I mean by that is often with our POS systems, a deposit doesn't necessarily reflect what our actual sales were that occurred within Square. And that's because Square takes their fees out, or maybe there's sales tax that's included in that. And a common inaccuracy is that when that deposit shows up in a bank account, the business owner will just call that all income. And so it's not really all income, right? Because it might have been sales tax, there might have a fee taken out. And so there are integrations with softwares like QuickBooks. The integrations are not always that great, but there can be a journal entry that's pretty simple that lots of business owners out there use. There's tons of YouTube videos on it. Plus, we can help you set it up to make sure that every month you are correcting that. And really the goal is, especially if Mike maybe with his business only uses Square for income, then his report is saying at the end of the month I had $10,000 in income. Then you want to make sure for an accuracy standpoint that in QuickBooks your profit and loss report then says you had $10,000 income. And if those two numbers don't match each other, then there's something that went wrong with that, right? And so, if we are seeking capital, right, and we are producing these reports from someone, and we have two reports that don't match, or then we have a tax return that then doesn't match those numbers. That's a big red flag to a loan officer or someone of that nature to say, okay, what was it, right? Ultimately, most of us are going to say it's the tax return because that's what I submitted to the IRS. But then the question is, then how are you making decisions for your business, right? When that's not matching what you're reporting to the IRS, or how did you even come up with that number? So there's where you have to be able to defend what those reports are. And so best thing to do is to make sure they all match, right? In the first place. So keeping receipts and bills, receipts, as I mentioned before, this is where software is nice because you can take images of those receipts and upload it in there, and then you don't even have to keep paper receipts anymore. Payroll records, absolutely, you have to have payroll records. Again, lots of things are electronic, and so you're going to have electronic copies of these. I'm no way meaning keep hard copies. I'm the first one to tell you I'm anti-paper. I cannot stand having paper or files. My son, on the other hand, has a farm. He loves paper. He thinks filing cabinets are the most amazing things. He still writes out invoices by hand. He's 20. I don't know where he came from. I don't think he fits into the generation at all from an electronic standpoint. We kind of reversed our roles with that. And then keeping your tax returns as well. So often when you're seeking capital, they are going to be asking for 3 years back. So that's the kind of the timeline from a capital standpoint. Obviously, from a IRS standpoint, you need to keep things much longer than that, but you're often going to be asked for 3 years worth of things. And then other loan and credit documents that you may have. So there's an asset liability list that you often have to provide. So if you have assets for your business, you're going to want to list those all out, right? And they're also going to show up on a report called your balance sheet. And then you're also going to list all of your loans on there or your liabilities. If you don't have either one of those, then you're not going to have anything that's on that list. However, if you do have them, you're going to want to make sure that you keep that. And then any major contracts, leases, or agreements, right? So these are contracts that you have in place. These are those types of legal documents that you're going to want to keep. So make sure that you're maintaining those somewhere, either electronically or hard copy. What does current bookkeeping mean? So I went through this before. I'm going to go through it again because this is really, as I mentioned before, the foundation to be able to create all of these reports or these documents that not only you're going to need to be capital ready, but also to be foundationally strong in order to manage your business and make those business decisions. So as I mentioned before, that chart of accounts, that is step one. If you do not have your chart of accounts accurate and simple being the most important word. When we don't know what we're doing, we tend to try to overcomplicate it. We'll add accounts in there that we didn't need in the first place, and then we have to end up scaling it back down. We make a lot of cleanup or corrections. It also allows us creativity to make mistakes when we have accounts in there that we don't need. I usually say take a Schedule C from the IRS, look at it, And that is the most simplest form of a profit and loss when you see a Schedule C. It's got your income on there and your expenses. That's what I mean by profit and loss. We're going to go through reports here in a minute too, so you can, yeah, if you're not familiar with those, what I'm talking about. Then you're going to make sure that your transactions are categorized correctly. What that means is every single piece of money that goes in or out of your business is that you put it into the correct account, into the correct category is the term. I like to think of it like buckets. So I took this and I put it in this bucket, and a bucket is all of those accounts that are in your chart of accounts. And then you're going to take your bank and your credit card accounts and you're going to reconcile those monthly. And remember, I said reconciling is making sure that all of those values that you have listed match everything that's on the bank statement. And if there is something that is not on the bank statement that you have in QuickBooks or on a spreadsheet, it is wrong and it needs to get out of there. It's going to throw off your bank balances, and that's how we end up creating problems within our balance sheet. It's also going to either overstate or understate how much income or expenses you have. So it's really, really important to make sure this is in my bookkeeping system and this is on my statement. And if it's not in either, if you can't say it's here and it's here, then it doesn't belong, right? And then questions to be reviewed or resolved. There's always questions. There's always one-off transactions that might happen within a month that you're just not really sure which bucket it's going to go into or which it should be. I always say the best fit, right? You're making your best educated guess right now. Put a memo on it, put a note, something that tells you in the future, this comes to that defending part, so that you can ask those questions of someone or try to explain it to someone when it comes down to maybe your tax accountant or the end of the year or one of those things. And then review your reports. So, really, really important. If you've never looked at your profit and loss or your balance sheet for your company before, that you are reviewing those every single month. So, the process of bookkeeping, if I'm going to simplify what it is that bookkeeping really is, we talk about it in 4 steps. Really, it's a 3-step process, but the first step being chart of accounts is accurate and simple. That's step one. We do that one time, and then maybe sometimes we have to add accounts to it if we buy equipment and things. Step two, which you're doing every single month, is you're categorizing every single transaction as it's happening throughout the month. Step three, we're reconciling all of our accounts. We're going to do that once a month, and we're going to do it once we've got our statements. And then step four, we're going to review our profit and loss and our balance sheet. And when we're reviewing our profit and loss in our balance sheet, we can have the confidence at that point, as long as we've categorized, as long as we've reconciled, we have the confidence right there that those reports from a value standpoint are 100% accurate, right? Because we went through all of our statements and we made sure that every single transaction matched our bank statement. And if it didn't, we resolved it. We got rid of it. We fixed it. Then we can look at our reports and we can say, okay, that makes sense. That makes sense. That makes sense. And we'll go through this a little bit more when we start to talk about what are we really looking at in our financial reports to make things make sense. So here we are, 3 reports that every owner should know: profit and loss statement, balance sheet, and cash flow. Most business owners will start with profit and loss to start understanding it. Once you start to understand your profit and loss, that's your income and expenses, right? These are changing rapidly in business, especially if we're selling a lot of things and we're spending a lot of money. This is where we're going to notice the most differences that are occurring. So most business owners will start here because this is how we're making a lot of decisions in our day-to-day business. Then our balance sheet. This is report number 2. This is telling us what does our business own and what do we owe. So this is where we're going to see all of our bank balances. We're going to see all of the assets that we own, the liabilities. Those are the things we owe. And we're going to see our equity in here too. So equity, as I mentioned before, is where we see how much money we've invested as an owner, as well as how much money we've taken out of the company as an owner. These are called owner's draws. So equity is known as the value of the business to the owner, because this is where we do a lot of our money coming in and money going out for ourselves personally. The Some business owners will get the profit and loss. They'll understand it, they'll see it, they'll know it. And then when Mike's mentioned there's some gaps, whether or not this is true, Mike, you can tell me. But that tends to be where the balance sheet is where the inaccuracies are, right? I don't understand why the balance is this, and then you just kind of ignore it and you don't fix it. And then the third report, which is actually one of the most important, is cash flow. So cash flow is where profit and loss and balance sheet, we're kind of looking backwards at our business, which is extremely important from a capital standpoint and making decisions. Cash flow is actually having us look forward so that we're able to actually have visibility into, can I spend this money today? Should I buy this right now? Do I have the money to do it? And so we've got to have some information definitely correct in our profit and loss in our balance sheet, as well as we've got invoices that we have entered. We've got bills that we've entered that shows us that more forward looking, so that we know when to expect to collect money and also when to expect to pay money out. And that's going to give us more visibility into that cash flow. So these three reports tell different parts of the story, as I mentioned, but together they truly help us understand our business. And so this is a little bit more about a profit and loss. So what does the profit and loss show us? Truly, it's showing us how much money our business has made. This is where we can tell if we have a profit or a loss. It's right there in the name. Purely simple. The very last line on a profit and loss report is called the bottom line, and that shows us if we have profit or if it's a negative, we have a loss. This shows us how much money we spent. So this is where all of our expenses are. It also tells us whether we made that profit or loss. It shows, and it helps us see where our money is going. So this is where all those buckets are, right, from an expense standpoint. And it's also going to tell us our revenue. So when I said Mike with his square, that the actual sales, the true sales number from Square, does it match our income on our profit and loss? And these are the two reports that we're going to match up. And if they don't, then we know that we have to go back and figure out why those two don't match. And really, this report in its most simplest form, just on the surface without really digging into it, is telling you whether or not your business is making money. Now, that's not the same thing as do I have money in the bank, right? This is just purely from a profitability standpoint. So when we look at our profit and loss report, then what we need to know is what our revenue trends are. So things that we're looking for. So we can look at our profit and loss from today. We can look at it for the week. We can look at it for the month. We can look at it for the year. We can compare it to last year. So it's a period of time, and it's whatever period in time we actually look at. If I want to know on this day, August 20th, this year, did I make as much money as I made last year on August 20th? I could, if I had all of my financial data set up right, and I'm using an easy system to pull it like QuickBooks, I could look at just August 20th in 2025 versus August 20th in 2026. And I could compare the two. Now, when we've got a lot of inflation things with the expenses and we're trying to do comparisons with did we spend the same last year as we did this year, this is the report that you're looking in order to be able to figure that out. We can also see what our largest expenses are. And we can watch those from month to month, year to date, those kinds of things. Compare it to last year. Are we spending more on materials this year than we were spending last year? Are we spending more on labor this year than we were last year? What does our advertising cost look like? Why did our rent go up? These are all questions that we can ask just by looking at this report. And then gross profit, if applicable. So in order to get that gross profit, we do have to have a differentiation in our expenses. And those two expenses, the way we can break those out, they're called cost of goods sold versus operating expenses. And so if you look over to the little doodle on the right of the report, you can see that cost of goods sold falls right under revenue. And the reason that our cost of goods sold falls there is because cost of goods sold is telling us our direct expenses that we had because of the revenue. So this is materials like if we buy products and resell them, that would be considered a cost of goods sold. I like to call those direct expenses versus operating expenses that are all indirect. So operating expenses are expenses that we were going to have no matter what. right? Just because we started a business, these are things like rent and advertising and, um, you know, I'm drawing a blank, interest expenses and depreciation expenses. There's a lot of expenses we're going to have regardless, just because we have a business. Those direct expenses, though, cost of goods sold, are directly tied to whether or not we're selling a product. Or directly influencing the fact that we're selling that product. And then we can see that net profit or loss, which that's that bottom line down there. So you can see the line across it, and we're going to know whether or not that's positive or negative. And then expenses that may be personal or miscategorized. So many times when I've worked with someone, the very first time that they look at their profit and loss, and they've never seen it before, they will start to pick it apart, right? So you're looking down through all of those numbers on the right-hand side and say, that doesn't make sense, and that's wrong, and that's incorrect, and why is that there? And one of the cool things about using something like a QuickBooks that's more interactive from the reporting standpoint is that you can actually click that number and see everything that you've put in that bucket when you were categorizing to be able to say, okay, I put that in the wrong spot, or I put this in the wrong spot. And those happen. They're very easy to correct, but this is definitely why you want to look at all these reports, review them, and make sure that you have confirmed then, okay, now I know the values are correct because I reconciled. And now I know that all of my categorizing into all those buckets were correct because I've reviewed these reports to the best of your ability, right? Someone may tell you, it might be better to put it here, or it might be better to put it here. But again, that's pretty easy to move them. So demystifying the P&L then, the profit and loss, it helps you answer, is your revenue growing, shrinking, or staying flat, right? Am I making more money? Am I making less money? Or am I just staying the same? You can tell this by comparing this month to last month, this quarter to last quarter, this year to last year. What does it cost to deliver what I sell? This is another one. So gross profit equals revenue minus those direct costs or those cost of goods sold. So if you've watched Shark Tank, they always say, what's your gross margin? One of the first questions. And they'll say, "Ooh, that's a really great gross margin," or "That's really terrible." Could you answer that question about your business today? Do you know what your gross margin is? In order to be able to know what your gross margin is, you have to account for all of your income. And you also have to have those direct costs there. And yes, to that answer, I will send you all a copy of these slides through Eventbrite. So you'll get a link to the recording as well as a copy of the slides. Am I pricing correctly? This is the next thing. Gross margin equals gross profit divided by revenue. So if we're trying to figure out that gross margin, as I mentioned before, this is the actual formula in order to be able to do that. Are expenses supporting the business or are they draining it? So you're looking at that largest or fastest growing expenses, right? So you're looking at those trends over time. Is an expense growing? Is it outpacing? Are my direct costs greater than what my revenue is, right? This is a big problem we do as far as our pricing is not correct or we're not selling something. Is the business actually profitable? So that is the easiest one to tell from this whole entire report, right? Because you just look at the bottom and you say, is that number positive or is that number negative? So that's how we know. And the example over to the right kind of tells you if I were going to pick out these numbers, we can see that we've got revenue at 50,000, we've got our cost of goods sold or direct costs at 20,000. That figures us out to have a gross margin of 60%. And then we can see all the way at the bottom, our net profit. Then after we take all those indirect expenses out, we actually have a profit then of $5,000. And this is key when we're deciding, do we need to sell more? Do we want to grow, right? So we're in grow phase. And sometimes our revenue does not outpace our expenses when we are in that phase. And we actually end up with less money at the end of the year or at the end of whatever period that we're measuring. We might sell more. We might sell $1 million, but actually have less profit. And so businesses will often find a sweet spot then between what their expenses are and what their revenue and what their goal is. It's not always the goal to sell more, right? Until we get our systems in place in order to help control those expenses. So key metrics here are that revenue trend, gross margin, net profit. Those are the big things that we're going to be able to see from those reports and be able to make those decisions. So it's more than just numbers. It's really a story of your business performance. And it's extremely important to understand it, not just understand it, but use it then to end up making those decisions. So the next report, balance sheet, what it shows, what your business owns, assets, what it owes, liabilities, and what belongs to the owner. That's equity. So our investments and our expenses. It does show the overall health of our business. It helps lenders understand your risk. Are you too big of a risk to lend money? You might have heard things like debt ratio. We're going to look at those here real soon. And it answers, where does my business stand right now? So what you're looking for on your balance sheet then, cash balances. So are our bank account balances accurate? We just had a business that we were helping the other day. Their bank account said they had $1 million in it. It was more like 1,000. So that cash balance, definitely inaccurate. Accounts receivable. This is the clock that is ticking once we have sent invoices to someone. So we send out the invoice, it creates something called accounts receivable. It's actually an asset. If we don't correctly apply that payment back to our invoice, it stays in accounts receivable forever. So really, it looks like we've generated the income, but then we're still expecting to receive the income. And that is a big red flag when it comes to funding, because a bank is going to expect you to be able to collect on something that's in accounts receivable. So if you have this huge accounts receivable and really your income is not that huge, that's saying, okay, there's a problem there. Credit card balances, we want to make sure these are accurate, right? So we're going to reconcile those every single month as well. Making sure that you have your loans and any other debt actually listed on your balance sheet is important. I've seen a lot of balance sheets without any assets or any loans on there, and banks can't appropriately assess your risk if those aren't on there. Those owner draws and distributions, as I mentioned before, in equity. So, how much money are we taking out of the business? Making sure that you're counted that for that correctly and that it's within the year that it's in. I just had a conversation earlier today. She said, I can't tell how much money I've actually withdrawn from my business this year because unless we do an adjusting entry, they're called at the end of the year from an accounting standpoint to be able to move owner's draw to retained earning, it just stays in there forever and it just keeps building up. So really, we could be looking at years of data that really is just telling us how much money we withdrawn from the company forever. That's something that's incorrect, and it's easy to correct it though. Unusual or negative balances. That's another thing. So, do we have a bank account that has a really negative balance, right? The banks don't usually let us overdraw very much. So that's a red flag. Same thing with the loan balance. So maybe we paid off that loan a long time ago. It's still sitting in there. It's showing it's got a positive balance or a negative balance. Then it's incorrect. Old balances that no longer make sense, right? That's something that's incorrect as well. This is just an example of a balance sheet. This came out of QuickBooks if you've never seen one before. This is a really big chart of accounts for a company that's actually very small. There's a lot of inaccuracies in here. It's a really good training ground, but I wanted to show you what a balance sheet report looks like out of QuickBooks. So demystifying the balance sheet then. So what this is really helping you answer, here's a lot of those equations again and ratios that you can actually determine some of these things. A lot of these are being utilized from a lender standpoint when we're seeking capital. So, do I have enough short-term resources to cover what I owe? They're looking at working capital, and so they're taking your current assets minus your current liabilities. Can I comfortably cover my short-term obligations? Can I pay my bills? Right. For things that are upcoming. The term current refers to something that's happening within the next 12 months. So these are often where credit cards live. This is the next 12 months of payments you might have in a loan. So a current ratio is those current assets divided by current liabilities. And then how much business is financed by the debt? This is a big one that I get asked a lot. I was told my debt ratio is off. So what is a debt ratio? That is the total liabilities, right? So everything that you owe from a loan, a credit card, those kinds of things, to my total assets. So everything that I own then. And that's what my debt ratio is. Then I have debt to equity, total liabilities divided by total equity. And then what is my business actually worth? Equity equals assets minus liabilities. Now, when it comes to business valuation, I do want to mention there is a lot more to it than just that number right there. But this is what it's worth on the books to you, right? When we look at what equity is. And this is also happens to be the equation for a balance sheet, right? So balance sheet is that equation. You can flip that around in lots of different ways in order to end up getting that same equation. So what is on the balance sheet over to the right? You can see what your total assets are. Assets equal liabilities plus equity. So we can see those numbers there. And then we've got those key ratios that really tell the story about the financial health of your business. And that's really the point of the balance sheet. And then we talk about cash flow. So where did the cash go? Actually, where is the cash going is another thing that the cash flow can help us look at. So it's looking at cash that's coming in, cash that's going out, the timing of those payments. So I always talk about utility bills. So our electric bill, we may get it today, but we may not owe it for 20 days, right? And so we're looking at cash flow and we really are doing cash flow type projections. We don't assume that we got the bill today and we're paying it today. And also, if we're invoicing someone, they may not pay us for 2 more weeks. And so we can start to break down what our expectation of cash flow looks like on a week to week basis. And we can make those better decisions as to when we actually pay those bills, pay those loans. We can buy a piece of equipment, right? The last thing we want to do is go out today, strap ourselves for cash, and then we have all these loan payments that we have to make in 5 days that we just didn't remember or we weren't really sure that we had to do. And maybe that our customers aren't going to pay us for another week or 2 weeks based on when their invoicing date is. So this cash flow, having visibility to that really helps us make those decisions. Debt payments, as I mentioned before, we want to make sure that we're paying our loan payments on time. Owner draws, when are we going to pay ourselves, right? When do we plan to be able to pay ourselves? Or when can we pay ourselves? Cash flow is going to tell us when we can withdraw that money. And then also inventory, equipment, large purchases. So we get to the point where we can make decisions to purchase inventory out of season potentially, so that we can get discounts and truly save our business money. So profit is an opinion. Cash flow is the fact. So we can have a huge profitability in our company and have zero money in the bank. Hopefully none of you have experienced that, but that's a very common problem, especially as our businesses are growing. So we see our cash coming in. Cash can be sales, customer payments, loans, or financing. We see investments and large purchases, so inventory, equipment, other improvements. Cash going out, these are expenses, suppliers, payroll, utility taxes. And then our end result is we want more cash in than out. That helps strengthen our business, and more cash out is what creates that cash strain. The biggest thing about cash flow is that we don't have emergencies or things that just come out of nowhere that make us panic, right? Or create an emergency situation where we're trying to maybe use credit cards, or we're going to get short-term loans, right, to cover different debt. Maybe payroll, right? That's another one that when that's happening and we have to pay our employees, or there's a vendor payment coming up. So getting to the point where not only do you know what your profit and loss is, your balance sheet, but cash flow is another one, and you start mapping that out all the time, you're going to have a lot less stress as a business owner. So, simple example, profit versus cash, because this does happen so often, is that your profit and loss or your P&L may show that you have $20,000, but where your cash might have actually gone is that you've spent $30,000, right? So you're on the other side of it. You had loan payments. Loan payments are not going to be on your profit and loss. Loan payments are to a liability. Equipment purchases or leases, this might be a fixed asset at a $7,000 amount. So that's actually going to show up on your balance sheet, not on your profit and loss, right? So that's not going to affect that profit and loss. Inventory, buying inventory, if you're truly managing inventory, inventory is actually going to sit on your balance sheet also as an asset until you convert it into that expense. So basically when you've created the product and sold it, or whatever it may be that you're doing with that inventory. Also, owner's draws. That's another thing that's showing up in your balance sheet and isn't on your profit and loss, because owner's draws are equity. And customers who have not paid yet. So I mentioned accounts receivable. So we invoice someone, they haven't paid us yet, so it's over there. That's how that strain is felt. So, what area do you feel that you are the least confident in understanding right now? You guys can answer that in the chat as well. A, your profit and loss statement. B, or balance sheet. C, cash flow. Maybe it's all of the above. D or E, I feel comfortable with all of them. Feel free to answer and share that answer with me. A, B, C, D, or E. And so, what may be requested during financing conversations? So, outside of these three things that I was talking about, there are a multitude of other items that are going to be asked for from a capital standpoint. And so, we talked about profit and loss statement, we've talked about balance sheet, business tax returns. So, typically 2 to 3 years worth of business tax returns. Bank statements may be required, obviously, to back up anything that you have on the profit and loss or balance sheet. As we know, both of those can be incorrect, right? So the bank statements are backing those up. Debt schedule, as I mentioned that before, that's going to be that list of all those liabilities or loans that you have. Any accounts receivable or payable details, so a list of all those invoices that you're awaiting payment, any bills that you have upcoming to be paid, those are your payable details. Financial projections. So, what are you going to be doing with this money, and what effect is that going to have on your business? Is that going to increase your revenue? Is that going to, change the expense structure that might be in your business? Those financial projections are very important for that. The use of funds explanation. What are you going to do with it? What are you spending it on? What's that plan? A business plan with financial projections. So, financial projections typically follow a business plan. If you've never, if you're newer in business, right, and you may not have those 2 to 3 years of financial history, a business plan might actually be something that you're going to create in order to tell that story, paint that picture, and you're going to include those financial projections. This is what your expectation is then for that business. And then personal and business credit reports. They're going to ask for both. We're tied personally to our businesses and pretty much every single way. So we need to make sure that our personal credit is good in order to be capital ready. But also our business is going to start building its own credit. They are two separate different things. And when we start out with business, obviously we don't have any business credit. It's just like when we're young and we don't have any personal credit, right? And we have to build that. Again, we have an entire workshop all about credit. It talks about personal and business and how to correct it and sort things out. So you want to be prepared and you want to be confident when you are ready for the loan. And you want to make sure that you have all of these things, right? Because you're going to be asked for them. And not having these prepared and accurate and confident about them is obviously going to delay that process. So historical versus current financial information. So past tax returns, prior year profit and loss, prior year balance statements. And these help lenders understand your track record, the different trends in your business, and your ability to manage the business over time. Your current information is going to be year to date financials, as well as recent bank statements, current debt, and recent business activity. So maybe you have new contracts. That's why it's important to have these. And the reason that you need the loan is because maybe you have to purchase equipment and inventory and whatever it may be because of this new contract. And obviously you've got that contract in place, and that's why you've got to do all these things. Lenders want to see the whole picture. So they want to see the history, they want to see the current, and together that really tells them the whole entire story of the business. And most importantly, can you explain the story behind all these numbers? If somebody was to ask you, why did your revenue change? What's the largest expenses are? How much debt the business has? Whether your cash is increasing or decreasing, and why? Any unusual transactions or one-time events that may pop up, and how financing would truly support the business. So not just what it's being used for, but would it support the business? And so they want to know, do you understand your business? Can you explain it? Are you managing it? Do you have a clear path forward that you're using this money? And can you handle the responsibility of financing? In the sense, can you pay that loan back? That's what they want to know. Turning the numbers into the story, your revenue went down by 8%. You're able to say the industry slowed down due to seasonality. We've had lots of up and downs in our economy recently that we could explain, right? But you need to be able to tell that story and directly tie it back to what your financial reports are telling you. If someone requested your financial information today, how prepared would you be? Very similar to the very first question. Now that you've been through more of this, maybe you might change your answer. But A, I could provide it quickly. B, I could provide most of it. C, I would need some time to pull it together. Or D, I would not know where to start. Hopefully, you now know where to start if you didn't know where to start before. But you guys can drop that in the chat as well. So Mike would need some time to pull it together. Thank you for answering that. So common problems. I'm going to fly through these because we've got about 4 more minutes, but common problems, I mentioned this before, is that the mixing of personal and business activity, and you guys will have the slide that you can go back and look at it. But we have to keep those personal details, information completely separate from our business. We do not want that to show up on any of our business reports. We don't want to have commingled funds. And we want to make sure that we've got clear delineation between what was an owner's draw or an owner's investment versus what are those actual business expenses. Bookkeeping is behind. This is a very common one. Everyone starts out in January with the best of intentions. I'm going to keep up on it. July happens to be the aha moment for some reason with a lot of business owners that they go, oh my gosh, now I'm 6 months behind, right? That's when reality starts to set in. By August, we're like, oh my gosh, it's almost the end of the year already, and I'm still behind. So months of missing transactions, there's gaps, bank accounts are not reconciled, things are uncategorized, right? So this is behind on bookkeeping, and we really got to get that up to date. You've been managing your business on the fly pretty much up until this point because you've not had visibility to your financial reports, right? And also, there are numbers that you cannot explain. So, loan balances that look wrong, either they're too high or they're too low compared to what a loan statement might be saying. Negative accounts receivable. We should never have an account negative accounts receivable. That's money we're waiting on. Old unpaid bills. So, when you have that bill schedule, if you've got bills from last year that you haven't paid, that's probably wrong. It's just an accounting thing they didn't accurately get accounted for in the system. Large uncategorized transactions. So anytime there's a miscellaneous, a general, an uncategorized that shows up on your profit and loss or balance sheet, that's a red flag because we should be able to put everything into some bucket. And if you have questions, obviously you need to ask someone to get that help. And then revenue that changed without any kind of explanation. So we had a jump, we had a loss, something like that, and we're not able to explain it. So clear numbers create those confident decisions. So our next 3 steps. Choose 3 actions to move your business forward. Everybody can do this. It doesn't matter where your business is. Choose one thing to organize. Example, tax returns, bank statements, loan documents. Just choose one, get it in the right spot, however your organization system is going to look like, and then move on to the next one, right? One thing to correct. Are we going to reconcile our accounts? Or are we going to clean up any miscategorized transactions? Are we going to go back to January and start categorizing our transactions, right? Maybe we have to start in January if we haven't started yet. And then one habit we want to maintain. This is reviewing our financial reports monthly or whatever it is that you want to continue doing that you know that you're doing to move your business forward to having that strong foundation for capital ready. Start small, make progress, build that confidence over time. And so capital ready does not mean perfect. Ultimately, in the end, it will, but we've all got to start somewhere. It means that your information is accurate, organized, current, and explainable. Not perfect, but prepared. You will always have to answer questions that you didn't expect to have to answer. Everybody's financials has them. That's why loan officers are looking for certain things and they're going to ask you many questions. If you know what's going on with your own business, if you know what these transactions are, it's really easy for you to answer those questions, right? And it's not a stressful thing. So if you are a Columbus-based business and you are not already in the Accelerate Columbus program this year, and what I mean by that is there are so many different things going on with the Accelerate Columbus program. You might be with the marketing people or the AI people or something of that nature. We are speaking specifically about finance with this QR code right here. You can scan that QR code. It's going to take you directly to our landing page that allows you to register for the program. So enter your information. We'll confirm that your business address or your home address, one or the other, is in the city of Columbus. So you do have to be in the tax base of the city of Columbus in order to qualify for this program. You can have free one-on-one consulting with a member of our team then to help you with any of these items that we discussed today. So anything in the financial world, or you want to set up QuickBooks, you want to learn QuickBooks, any of those things. The Accelerate Columbus program is a great program. We were the partner for financial last year. I know some of you on this call definitely have been part of the program before. I recognize your names, as well as you might be part of the program this year as well. We did have one question in the Q&A. What would be asked for in an audit? I think that just depends on the type of audit. If you're talking about like an IRS audit, they're going to open up your finances and look at everything. And so that's why it's very important. One of the reasons that it's very important not to commingle personal and business money, especially if you're in a financial audit with the IRS, because they are going to start scrutinizing a lot of your personal items in there as well. So making sure that you truly know how to handle personal versus business and have those accurately accounted for is huge. You do want to protect yourself, not just from an audit from the IRS, but also it opens you up to liability, even though we try to protect ourselves from a liability standpoint. Does anybody have any more questions? We are now past 5 o'clock, and I know you guys are probably all tired of hearing me speak this whole entire time, but it was a lot of information. You will, as I mentioned before, get a link through Eventbrite. I'll send that out as soon as I have this uploaded. It will be on our YouTube channel that you can watch, as well as anything else that's on YouTube. But if you have a question, feel free to go ahead and drop it in the question and answer. Otherwise, thank you all for taking the time to invest in your business and learn about this. And I look forward to seeing you guys in the future. You're welcome, Liz. Thanks for joining. All right. No more questions. Have a good evening. Bye, Mayo. Glad you made it in.